Crocs just reported net income of $342.4 million against a net loss of $332 million a year earlier, a swing of nearly $675 million. Yet revenue moved less than 1% and gross profit fell. When the bottom line moves that violently while the top line stands still, the explanation lives in the comparison, not in current trading. So we take this filing apart line by line: segments, margins, cash, balance sheet. Crocs Incorporated is a NASDAQ-listed footwear company reporting in two segments. The Crocs brand, the clog franchise, brought in $1.77 billion, 84.1% of group revenue. HEYDUDE, the acquired casual brand, contributed $333 million, just under 16%. That split matters. One brand is growing slowly, the other is shrinking. And almost every question in this filing comes back to that divergence. First, the basis. These are cumulative figures for the first 6 months of the fiscal year through the 30th of June, 2026, not a standalone quarter. Revenue was $2.1 billion, up 0.7%. Operating income came in at $486.5 million, against a loss of $204.5 million, an improvement of $691 million. Diluted earnings per share were $6.83, against a loss of $5.94. Operating cash flow reached $270.8 million, up 23.9%. Only one of those four, the cash flow, reads clean. Last year's first half showed an operating margin of -9.8% and a net margin of -15.9% on similar revenue. You don't lose $200 million at the operating line through ordinary trading. There was a large one-off charge in that base period. We can't name it from this data, but the arithmetic points straight at it. Gross profit fell 2.1%, yet operating income rose $691 million. One more tell. Last year's $88.5 million tax charge on a pre-tax loss, typical when a write-down is not deductible. This year is clean. Operating income of $486.5 million flows to pre-tax income of $442.8 million, then to net income at a 22.7% effective rate. The period is honest. The comparison is not. Now the segments. The Crocs brand grew from $1.72 billion to $1.77 billion, up 2.7%, and at 84% of revenue, it does the heavy lifting. HEYDUDE went the other way, from $365.5 million down to $333 million, a decline of 8.9%. HEYDUDE gave back roughly $32 million while Crocs brand added about $47 million. Net them, and you get the $14 million increase that shows up as group growth of 0.7%. So the group isn't flat, it is two brands canceling out. HEYDUDE is also the most plausible home for last year's charge. Gross margin came in at 58.2%, down from 59.9%, a fall of 1.7 percentage points. The cause? Cost of revenue rose 4.9% to $877 million, while revenue rose 0.7%. Costs growing 7 times faster than sales means pricing, mix, or input costs are moving against you. Selling, general, and administrative expense rose 2.4% to $734 million, also faster than sales. Both major cost lines outgrew revenue, so operating leverage is running in reverse. Operating margin of 23.2% and net margin of 16.3% flatter, but carry the base effect. The clean read here is gross margin, and it went down. The cash flow statement is where this company looks genuinely better, and this is not a base effect. Operating cash flow was $270.8 million, up 23.9% on revenue that barely moved. Capital expenditure was only $38.7 million, below depreciation and amortization of $40.3 million. That leaves free cash flow of $232 million against $187 million a year earlier. The model is asset-light, little reinvestment, so most operating cash drops through, and that funds the capital returns. The caveat is the same fact inverted. CapEx below depreciation for long enough becomes underinvestment rather than efficiency. Now, the most important item. Operating cash flow of $271 million sits against net income of $342 million. Cash conversion of roughly 79%. Profit is largely cash-backed, but not fully, and the gap has an address. Accounts receivable climbed to $430 million from $278 million at the start of the fiscal year, a build of $152 million, up almost 55%. Against revenue growth of 0.7%, money owed grew far faster than the sales behind it. Inventory, by contrast, is well-behaved at $389 million versus $369 million. Two innocent explanations: seasonal first-half shipments and simple timing. Two less innocent: sales pushed into the channel or looser payment terms. This data cannot separate them. It's the clearest quality signal in the quarter. These balance sheet changes are measured from the start of the fiscal year, not year over year. Total assets stood at $4.36 billion, up 4.3%. Almost all of it the working capital we just discussed, not acquisitions. Total liabilities were $2.97 billion, with long-term debt rising to $1.31 billion from $1.23 billion. Cash was $170 million, up from $130 million, but thin next to $728 million of current liabilities. Debt to equity sits at 2.15 times, current ratio 1.49, return on equity 24.7%. Leverage is elevated and returns look high, partly because the equity base is smaller. Operating lease obligations aren't broken out here, so true net leverage for a retail business is probably understated. This is where the per-share story is made. The company repurchased $256 million of stock in the first half, up almost 32%, and the diluted share count fell to 50.2 million from 55.9 million, down 10.3%. The equity bridge, retained earnings rose $342 million, matching net income, yet total equity rose only $91 million since the start of the fiscal year and sits below its end March level. Buybacks absorb the difference, while long-term debt rose roughly $77 million. So repurchases are funded partly from free cash flow, partly off the balance sheet. And on the 30th of July, the company disclosed a $1.5 billion increase to its authorization, taking remaining capacity to around $2 billion. The intent is clear: deploy the balance sheet, not pay it down. On insiders, the data is clean and empty. Zero open market purchases, zero open market sales, no reported transactions at all. That is neither bearish nor bullish. Directors and officers gave no independent read on these results. On events, there is exactly one: the 8K filed on the 30th of July, carrying second quarter results and the $1.5 billion buyback increase. Medium importance, positive sentiment, and consistent with the cash flow statement. Real free cash returned through repurchases rather than banked or used to cut debt. What to check when the next filing lands? 4 things, all measurable. 1. HEYDUDE. Does the 8.9% decline flatten or steepen? At 16% of revenue, it decides whether group revenue grows at all. 2. Gross margin. Cost of revenue grew 4.9% against revenue growth under 1%. If that persists, the 1.7 percentage point compression is structural. 3. Receivables. Does that $152 million build convert into cash next period, or do the questions about shipment timing and payment terms get sharper? 4. Roughly $2 billion of remaining buyback capacity against long-term debt that is already rising. Each has a number attached, so each can be checked. Overall earnings quality reads as medium. The period is clean, no below-the-line gains. 79% of profit cash-backed, while the comparison is distorted. 3 ways this develops. Weak case. HEYDUDE's decline spreads into the Crocs brand, gross margin keeps the sliding, receivables convert poorly, and debt-funded buybacks run against an equity base that isn't growing. Middle case. Low single-digit revenue growth with Crocs brand offsetting HEYDUDE, margins near current levels, and earnings per share improving mainly on fewer shares. Strong case. HEYDUDE returns to growth, gross margin rebuilds toward 59.9%, and free cash flow of 230 million or more funds repurchases without further leverage. In two of the three, the per-share number is driven by the share count. The one line to take away: the swing from loss to profit is the absence of last year's charge, not the arrival of new growth. Revenue rose 0.7%. Gross profit fell 2.1%. Gross margin gave back 1.7 points. And both major cost lines outgrew sales. What genuinely improved is cash. Operating cash flow up nearly 24% and free cash flow of $232 million. What moves the per-share numbers is a share count down more than 10%, funded partly with debt. So the per-share trajectory now depends on capital allocation more than on trading. Thanks for watching my stock analysis. This is educational analysis of the filing, not investment advice.